Welcome to the B.F. Anderson Technical Report for October 29th. Bill Miller says the Fed's new inflation policy is the most important market event in 40 years. Now, Bill Miller, who I have studied extensively, is one of the most successful mutual fund managers out there. He ran the Legg Mason Value Trust, a very successful fund. But anyway, we all get hung up on what's going on with the presidential race, or get hung up on what's going on with the coronavirus, or there's the most important thing is the fact that interest rates are staying low. So as we look at interest rates, you can see that interest rates have been basically in a downtrend. Now, this is the 10-year U.S. Treasury yield, and it's been in a downtrend, now trying to base. Now, if interest rates can get above 1% on the 10-year note, that could be meaningful. But the point here is that don't fight the Fed. It's the most important thing. So if we go back and look at things on a historic basis, if we go back to 1966, now unfortunately my graph doesn't go back to 66, but from 1966 to 1982, in other words, the market hit 1,000 in 66, did not get back above 1,000 until 82, which was a period of hyperinflation. We had 16 years of a sideways market. That was horrible. I started in the business in 76, and you couldn't give a stock away. Now, so we went sideways for 16 years, but then in 2000 to 2016, we went sideways again for 16 years. So 16-year sideways, 16 years sideways. And also note the 50-month moving average. I mean, once we lifted off and got going, the New York Composite stayed above the 50-day moving average. But you can see these bear markets in here. So, but if you look at where we are now, we basically are staying above that 50-month. Now, 1982 to 2000, this period here, was an 18-year bull market, interrupted by the crash of 87, which was quite difficult. Now, 2016 to 2020, we have started a new bull market that's only 4 years old. So the point being is, if interest rates stay low or even rise a little bit, money's going to come out of the bond market, it's going to go into the stock market, and it could really lead to a major bull market. So let's look at current trends. Now, we all know that today the Dow dropped 900 points. We had mentioned last week that we were a little concerned about the correction not quite being over. We peaked on September the 1st and then came into a correction. The market dropped 10% in 3 days, quite a drop. Then got below the lower moving average, which is what we're looking at. Now we're back below the lower moving average again. So I think caution is the word here. Now, on an intermediate term basis, we would say that things still look pretty positive because the NASDAQ continues to hold above the 35-week moving average, and the 35-week moving average is in an uptrend. So what that basically means is we're still in a bull market. It's just that we're going through a correction. But I must say, every correction every bear market I've ever experienced started with a correction. So you just kind of have to be careful. Now, on a long-term basis, these are the monthly graphs. As you can see, we're still on a golden cross on the S&P 500. We're still on a golden cross on the NASDAQ. We're still on a golden cross for China. And actually, China is holding up a little bit better than the U.S. markets. Now, the aggression index continues to kind of flounder here. We're having trouble holding that 50-day moving average. So we need to go to the actual indicator, which is a weekly indicator. And we want to stay above the 40-week moving average, and the index or the ratio stays above the 40-week moving average, and the 40-week moving average stays in an uptrend. So the aggression index, which is comparing NASDAQ to consumer staples, continues to be constructive. Now, on our three economic indicators, as we mentioned here, interest rates, they just can't seem to get going. So, you got this downtrending 200-day moving average, so forth. Now, oil had a rough day today, and you can see where the 200-day moving average is in a downtrend as well. Now, on the financial stocks, you can see here that the financials are just not able to get going. It doesn't look positive. Now, on the S&P 500, on the 25-day and the 50-day, you can see the break below the moving averages. Now, on the 200-day moving average, we're still somewhat constructive. We're above it and so forth. Okay, new lows. Now, we started to see a little bit of a troubling number here 2 days ago, which was over 40 new lows, which was somewhat of a warning as to where this market might be going. New highs, you can see where the new highs are starting to taper off again. We would like to see the new highs start to improve. Again, I think caution is appropriate right now. Put call ratio, where we're measuring sentiment, mainly institutional sentiment, still in greed. However, this is a 10-day moving average. The actual number is still around 48. So we're still in greed. Volatility index, which is the VIX, spiked today above 30. Again, it's telling you to be cautious. All right, now we use a set of indicators called the tides. The tides come in, the tides go out. It's 5 indexes. So what I did is I went ahead and compressed these indexes into a 3-month chart so that you can clearly see what's going on. So you see here with the S&P 400 mid-cap stocks, they pretty much have rolled over and broken down below that lower moving average. So that's a sell signal. It's telling you to be cautious. Now here is the New York Composite. Look at this. Really dropped hard today, mainly because there's a lot of banks and oil stocks in this particular index. Again, the tides, the way it works is we have 5 indexes. If 3 out of 5 give a sell signal, which means a break below the moving averages, it's time to get cautious. Here's the small cap, same story. Everything's breaking down. This is not a good picture. Here's the S&P 500. You can see the breakdown here as well. So we are on a sell signal on the tides right now. Again, it's time to be cautious. So on the top 5, this is Align Technology. You can see a major gap up when they announced earnings. They really knocked the ball out of the park on their earnings. They were fantastic, and you can see 5 million shares came in, gapped the stock up. Continues to look positive. I could take a position in the stock if the market straightens out. Here's Digital Turbine. Again, you got that 10-day rolling over. This doesn't look really very good, but it's in our top 5, so we just look at it anyway. Breaking below the 50-day moving average, I wouldn't touch it. Here's Ceres Therapeutics. Again, holding above the 50-day. However, broke down below the 10-day and gave what we call a violation, so we would avoid this as well. Here's Peloton Interactive, same story. We got a break and then a violation, moving sideways. We would stay clear. Here's Tesla. Again, we sold Tesla back here, and we really had a good year with Tesla. Tesla's been a really good stock for us. But what we had here was where it broke below the 10-day moving average, and then it violated the 10-day, then gave a violation. So we sold right about in here, and that's exactly where the stock is now. So what you need to understand about these violations is it's a warning. So if you have any questions, give me a call. Happy to help you with your portfolio. Thank you.